We've probably heard the rule. Spend no more than 3 times your annual salary on a house. So if you make $80,000 a year, that's a $280,000 home. Here's the problem. In 2026, the median home price in the United States is around $420,000. That rule doesn't just stretch, it snaps. And yet, thousands of people are still using outdated guidelines to make the biggest financial decision of their lives. Some are buying way too much house and quietly drowning. Others are waiting on the sidelines thinking they can't afford anything when actually they can. In the next 10 minutes, I'm going to show you exactly how to calculate what you can actually afford, not what a bank will lend you, which is often very different, and I'll walk you through the real numbers so you can make a decision based on your life, not someone else's formula from 1985. Let's start with a myth. A lot of first-time buyers think, if the bank pre-approves me for $450,000, I can afford $450,000. No, a bank's job is to lend money. They approve you for the maximum amount you can qualify for based on income, credit, and debt, not based on what leaves you with a comfortable life. Banks use something called the front-end and back-end debt-to-income ratio, or DTI. Front-end DTI looks at your projected housing costs, mortgage, property taxes, homeowners insurance, and HOA fees if applicable, as a percentage of your gross monthly income. Most conventional lenders want this below 28%. Back-end DTI looks at all your monthly debt payments, housing plus car loans, student loans, credit cards, everything, as a percentage of gross income. Lenders typically cap this at 43%, though some will go to 50%. And so here's a quick example. If you earn $90,000 a year, your gross monthly income is $7,500. 28% of $7,500 equals $2,100. That's your maximum housing payment by the front-end rule. At today's average 30-year fixed rate of around 6.8% in early 2026, a $2,100 monthly payment on a 10% down payment gets you to roughly a $300,000 home, not $450,000. The bank might still pre-approve you for $450,000 if your DTI allows it, but your payment on that would be closer to $3,100 per month, nearly 42% of your gross income going just to housing before taxes. That's the pre-approval trap. Even when buyers look at the mortgage payment itself, they're often missing 4 costs that can add $500 to $1,500 per month on top of that number. Number 1, property taxes. The national average is around 1.1% of the home's assessed value per year. On a $350,000 home, that's roughly $3,850 a year, or $320 a month. But this varies wildly by state. Texas homeowners pay nearly 1.8%, while Hawaii homeowners pay under 0.3%. Look up your specific county before you buy. Number 2, homeowners insurance. Average nationally is around $1,400 to $2,200 per year in 2026, but if you're in a flood zone, hurricane corridor, or wildfire risk area, you could be looking at $3,000 to $8,000 or more annually. This is non-negotiable. Your lender requires it. Number 3, PMI, private mortgage insurance. If you put down less than 20%, you'll pay this until you hit 20% equity. It typically runs 0.5% to 1.5% of the loan amount per year. On a $320,000 loan, that's $133 to $400 a month added to your payment. Number 4, maintenance and repairs. The old rule of thumb is to budget 1% of your home's value per year for maintenance. On a $350,000 home, that's $3,500 annually, or about $290 a month into a savings fund. Older homes or homes in harsher climates often run higher. Add those 4 costs together, and you're easily adding $700 to $1,500 a month on top of your base mortgage payment. Factor them in before you set a target price. Here's the framework I recommend. Instead of the old salary multiple rule, it uses your net income, what you actually take home, not your gross. Step 1. Calculate your monthly take-home pay. If you earn $90,000 gross and you're in a 22% tax bracket with state taxes, you're probably taking home around $5,800 to $6,200 per month after taxes and retirement contributions. Step 2. Apply the 30% rule to your net pay, not gross. 30% of $6,000 net is $1,800 per month for all housing costs, mortgage, taxes, insurance, and PMI. This is a conservative but sustainable target. Step 3. Back calculate your home price at 6.8% interest, a 20% down payment, and factoring $500 per month for taxes and insurance, and $1,800 total housing budget gets you to a purchase price of roughly $230,000 to $250,000. Step 4. Check your down payment situation. Can you put 20% down to avoid PMI? If not, factor that PMI cost back into Step 2. Also confirm you'll still have 3 to 6 months of emergency savings after the down payment, not zero. This isn't the most exciting math, but the buyers who run these numbers before they fall in love with a property are the ones who still feel financially comfortable 5 years later. One useful tool here: the Consumer Financial Protection Bureau has a free home affordability calculator at consumerfinance.gov. It lets you plug in your income, debts, down payment, and interest rate to see what mortgage payment range you should be targeting. I'll link it in the description. Now, are there situations where going above 30% net income makes sense? Yes, but only under specific conditions. Condition 1. Your income is growing rapidly. If you're a nurse, software developer, or trade professional with a clear income trajectory, say you're at $80,000 today, but realistically at $110,000 in 3 years, buying slightly above the conservative threshold now can make sense. You're locking in a fixed mortgage payment that becomes easier to carry as income grows. Condition 2. You're buying in a market with strong appreciation, in cities with constrained housing supply and strong job growth. Think Austin, Nashville, or parts of the Mountain West. The cost of waiting can exceed the cost of stretching. But this is a calculated bet, not a rule. Condition 3. You have very low other debt. If you have no car payment, no student loans, and minimal credit card balances, you have more room in your cash flow than the DTI ratio suggests. If none of those apply to you, don't stretch. A house that's technically affordable on paper can become a financial anchor if the market softens, your income dips, or an unexpected expense hits. And so here's the honest summary. Forget the 3 times your salary rule. The right number depends on your net income, your other debts, your local tax and insurance rates, your down payment, and what you need left over to actually live. Run the numbers using your take-home pay, not your gross. Budget for taxes, insurance, PMI, and maintenance on top of the mortgage. And make sure the bank's pre-approval doesn't become your target. It's a ceiling, not a recommendation. If you want to go deeper, the next video in this series covers first-time homebuyer programs that can reduce your down payment requirement significantly. Check that out next. If this helped you, subscribe. I put out new real estate content 3 times a week. See you in the next one.